Welcome to the Daily Brief, where I'll go over the action in the market for Monday, March 6th, and then we'll see how things look for Tuesday, March 7th. We had kind of a mixed day overall. We were up with the S&P, but we gave back a lot of the gains that we saw earlier in the session. Also, the mid-caps and the small-caps had a pretty down day, and that could be bringing in some weakness into the market. But we're also in this phase where we're looking like we're shifting more positive, but there are always some warning signs to be aware of, and I'll go through those in this video. So let's go back and talk about what happened. Right at the open, we had a gap higher open. It looked like things were really positive right after the open. Prices moved above R1 at 40.64. As the day went on, prices moved higher, but did not get up to R2 at 40.83. Once the buying seemed to exhaust itself, prices then retreated all the way back down to the unchanged level before closing just a little bit off of the daily low. We were up 0.07%, so virtually unchanged. On below average volume, that seems to be the norm for right now. Whether we have an up or down day, we're seeing volume really trailing off. The technicals are shifting more positive, but they're still negative overall, so we're kind of in flux right now because of this inflation and interest rate scenario. Of course, there's all of the geopolitical concerns with Russia, Ukraine being at the top. And there'll be some testimony that will be happening on Tuesday and Wednesday where Chairperson Powell will be speaking in front of Congress. And I'll talk more about that in a moment. Here's the intraday chart where we gapped higher. We were able to get above R1. We kept on going up, but we never got up to R2. We trailed along sideways, and when that seemed to run out of steam, we fell all the way back down to the unchanged level, which acted as a support level, and then bounced up just a little bit from that into the close. What are some comments that we can make? Growth and large caps did better in Monday's session than value and small as well as mid caps. The dollar was down slightly and interest rates were up, so this provided a little bit of headwind as far as interest rates, but the dollar being down slightly gave some support to stocks. We still have all of our yield curves that remain inverted. Sentiment is still neutral. We're giving a reading of 54, where that's the same as what we saw after Friday's session. And our trend is still positive overall. The green line's on top, but it is weakening with the ADX going down, and it's also below its moving average, although it's trying to turn back up slightly, and I'll show you that chart. And we're below 20, so we're in a trendless environment. Our bias is positive. We've had 3 up days in a row now, and I've switched our momentum over to positive from mixed, even though it's kind of a shaky positive. As far as the economic reports that came out, we had factory orders coming in at down 1.6% on a month-over-month basis. They had expected it to be down even more at minus 1.8%. Last time we had this report, it came in up 1.7%. Shipments of manufactured goods came in up 0.7% on a month-over-month basis. Last time it was down 0.6%. The Ulcer Index is still above its moving average. We're not necessarily seeing this reflected in the VIX, but we are seeing it in this particular indicator where fear is going up slightly. Here is the VIX where we were pretty much unchanged on a closing basis. We're well below 20. We're well below these moving averages, and I have another new chart I'll show you in just a moment. And on the bar chart, we're also declining and showing that there's a lot of complacency in the market. Here's the VIX of the VIX, which also shows the VIX is really slowing down, both with the bar chart and the line chart. Here's a new chart where I showed this over the weekend in one of the videos that were posted. And what I'm trying to do with this is get a range for the VIX. The VIX is on here, but it's invisible, so you can't see that. What you do see is a 50-period exponential moving average of the VIX. And I'm trying to see where is the range that we're falling into. Back from 2008 through about 2012 into 2013, we had a high up around 40 and a low down around 20. Then from 2012 or 13 into 2020, right before the COVID plunge, we settled into a range that was below 20 and got all the way down to 14, 13, even hit very low where we're just above 11. And these red lines I just put on here as kind of guideposts to see what is the overall range doing. After the COVID plunge, we spiked back up, and this seems to be the current range that we're in right now. The current reading is 22.67, so we're above that 20 level. This is supposed to be more dynamic. Instead of just using static numbers that don't change, the idea behind this is to give us a clue as to what's happening and then being able to adapt to current market conditions. This shows us how value was actually down on the day. where growth was still up. Large cap growth did outperform large cap value. Where we see some real weakness is in the mid caps and the small caps, and they were down pretty much across the board, even though growth wasn't down quite as much. This chart just shows how we came right up to this double exponential moving average based on 50 periods, and we could be hitting overhead resistance at that level. If we do continue to go up, we might hit other resistance at this anchored moving average going back to the all-time high, which is currently at 40.83. Another area of resistance could be the 20-period moving average of the open, high, low, close, where we came right up to the 20-period moving average of the high, and that's where we started to fall back down. The force index continues to be positive. This is a shorter-term indicator where it switched positive after Friday, and it's continuing to go up, so that is short-term positive. Here's our ADX showing how it's trying to turn up, but we're not above the moving average yet. The green line is on top, where the red line is declining. We're in a trendless environment, but we default to positive because of the green line. Here's the daily chart showing how, on a positive basis, we were able to stay above this pivot level, but this is not a real friendly-looking candle. To open, go up high, and then close pretty much near the low for the day, that's not really encouraging, but we are maintaining price above this support level. Down on the bottom, we see where volume continues to be below average. The stochastics, we're not getting any extreme readings right now. In fact, all of our short-term indicators are not giving us an extreme positive or negative reading. Where the short term is still going up overall, the intermediate term is trying to turn back up. That's looking more positive, and we're still turning up but have not crossed the moving average with our long-term stochastic. Here's the 20-period moving average, which is a really good barometer of short-term action, where we were able to get above the simple moving average, that's the red line, and we closed just a little bit down below it, but we're still above the exponential moving average. Here's our moving average tree showing pretty much the same thing. As price is jockeying around, this is looking more like a spaghetti mess. Just to update on our oscillators, in the short term, we're turning more positive with the slope. The TSI is also turning up but has not crossed. Our intermediate term oscillators are turning up slightly with the MACD but not positive, turning up a bit with the PMO and the PPO, where our longer term oscillators continue to decline. Parabolic SAR, we still have a dot underneath, so that is positive. We saw this switch over to positive after Friday's session, and it remained so after Monday's session. The Chaikin oscillator, after getting a little bit above the dash line, that was more positive. It turned down slightly in Monday's session. The PMOs that are rising tick down just a little bit, but we're still positive overall. We're turning up with our buy signals after being extreme negative, and we were flat with the percent of PMOs that are above zero. Swinland Trading Oscillator continues to be positive based on price and volume, and we're above zero. The bullish percent index was able to cross back above 50, so that is somewhat positive. And the NYSE bullish percent index did turn up just slightly. The Chaikin money flow, it has been declining. We're still below this moving average, but we're still hanging in there above the zero line. The balance of power has switched back more to negative. We drop below this dashed line. The TCM squeeze is showing some improvement as we're seeing lighter colored red bars advancing. The go-no-go system is still negative. We have brown bars over here after flashing a no-go sign. Looking at our fib levels, not really telling us anything new. We're still in between different support or resistance levels on the short-term fib chart, as well as the longer-term fib chart and the very long-term fib chart. If we continue to fall, we'll be looking at this 40-20 level, which had been resistance. Now that we broke through that, if we start to decline, we'll see if that does provide any kind of support. The Elder Impulse system for the S&P 500 is continuing to be positive. And the McClellan oscillator, after getting above zero, has now dropped slightly below zero, so that's more of a mixed to negative sign. And the broader measure of the NYSE McClellan oscillator also declined and is still below zero, so that's more negative. The summation index based on price is going sideways, where we're turning up slightly based on volume. So that's mixed, but with a positive slant based on the volume indicator. New highs, new lows, saw a little bit of an advance in the new highs, but our moving average continues to be declining even though it's trying to turn up, and our 10-day is trying to turn up as well. So this potentially could be positive for looking inside of the S&P to see what strength is really developing. The advanced decline line based on price and volume did decline ever so slightly, but we're still above both moving averages. The advanced decline ratios chopping right around the 0 point. The blue line went above but then fell back, where the red line continues to be below 0. Accumulation distribution is still positive. We're above this moving average, although it did decline in Monday's session. And volume continues to drop off, with the histogram trying to go back up, but now it's going back down. We have the indicator a little bit below the moving average. The Dow went right up to its 50-period moving average before hitting resistance and then falling back down. But the diamonds still remain positive overall. The NASDAQ is still above this pivot point. We closed right at the pivot point after Friday. We're still above it after Monday, even though we saw some weakness coming into the market during the latter part of the session. And the same thing with the NASDAQ 100, still above this pivot level. The Qs remain positive, and small caps, which really got hit. It came right up to this pivot level and is now falling down, but we're still above this 50-period moving average. The small caps for the Elder Impulse system have now switched over to negative with a red bar. The small cap to S&P 500 ratio really took a hit. We're still in an overall uptrend, but this really fell in Monday's session. The mid-caps also came up to this pivot level and then have fallen back, but we're still above this 50-period moving average. The mid-caps have switched from being positive over to neutral. Here's another look at the small caps, where we're still maintaining support at this current level. The RSI had been showing an improvement going above 50, while it now dropped below 50, and we're still seeing a declining MACD, even though it was giving a try at turning up. We're keeping an eye on the home builders as well. We had the S&P up. Home builders were actually down a little bit, so our ratio declined slightly, and we're watching this correlation down at the bottom, where they're not having as strong of a tendency to go in the same direction. If this really starts to fall and the S&P is going up, that could be a negative divergence. What we want to see is the home builders going up and the S&P going up together. Looking at bond yields, after getting above 4% late last week, we've fallen below 4%, but we spiked back up in Monday's session, although we're still under 4%. And here's the price of bonds. After really declining, had more of a real sharp decline before starting to bounce back up. The RSI on the top continues to be negative. It's below 50, and we're seeing a declining MACD on the bottom. One chart that I did bring up over the weekend, and this is a long-term chart of the weekly S&P 500. I was watching a video last week, I think it was Game of Trades, where they brought up this scenario looking back at different times when it looked like we broke out above a trend line, only to see the market think that it was going back up and then fall apart right after that. What they cite in that video and what I talked about over the weekend is what was the MACD doing at that time. If you look back to 2001 into 2002 and 2008 or thereabouts, the MACD was not confirming the upward price movement. The MACD was not even able to get above the 0 line. Well, we're seeing a little bit of a difference right now. The MACD is above the 0 line, even though it's rolling over a little bit, and we're going to be keeping an eye on this to see, is this breakout of this trend line valid? Or is it just a fake out to get a lot of people suckered into the market before it's getting ready to tank? We'll be keeping an eye on the MACD because it is above 0 and it is advancing, although it is showing some weakness. An update of our possible positive scenarios. We dropped below the 0 line with our 19-day exponential moving average of the advanced decline ratio. The 2-year Treasury yield is continuing to go up higher, so we're waiting to see when a new spike will be drawn. And our staples to S&P 500 ratio still is looking okay. We were coming back up, but now have been falling back. So this spike is still looking valid, but we're not seeing any real massive movement in price, which is what we normally see when we get these kinds of readings. What's our outlook for Tuesday? Fed Chair Powell will be giving his monetary policy testimony, and this is scheduled way before it even happens. He goes in front of Congress 2 times every year, and on Tuesday he'll talk before the Senate, and then on Wednesday he'll talk before the House. The interesting thing about that is he'll start off the meeting with some prepared comments, and on Tuesday that'll be the first time anybody's hearing those, and the market may react to that. He'll say the same thing on Wednesday, and the market won't really react to that. It'll be the question and answer period, because he has to be very careful of how he says things, so the market will be really in tune to that, trying to see how does he say it, how does he move his voice when he's saying different words, what are the inflection points, what are inference points, and they'll try to get something from that and then react. And then we have the big report of the week coming out on Friday, which will be the employment situation report. When that came out a month ago, that's what really freaked out the markets because it was much stronger than expected. So there's a lot of anticipation coming up to this report. The technicals are still negative overall. Best, we're at more of a mixed picture, but we're trying to turn back more positive. We have wholesale inventories and consumer credit coming out in Tuesday's session, then the whole list of geopolitical events, with inflation and interest rates being the real focus for the markets. As I stated a minute ago, both on Tuesday and Wednesday, Chairperson Powell will be speaking before Congress, and then on Thursday, Vice Chair Barr will be talking about crypto at 10 a.m. Eastern. Looking at the Stock Traders Almanac, just going through for Tuesday, March 7th, where the Dow is neutral to positive, it's up 52.4% of the time. And the same is true for the S&P, where the NASDAQ tends to be much more negative. It's only been up 38.1% of the time. And then all the other areas that are providing a fairly positive backdrop in the market, but we're still having this battle going on with the Fed and them raising interest rates. Here's a look at trading day number 5 for the S&P 500. That's the green line. Since we are in a pre-election year, it still has a slight tendency to go up before we start going down to sideways, where in a normal year, we're starting to go lower already. So there's a little bit of positive bias being in a pre-election year like we are right now. Also, we're coming into that sweet spot for March, where we typically see some pretty good returns. The gray line is what we're following right now. And that's the one that's on top and seems to be doing the best. And then we're also in the sweet spot as we're coming out of the midterm year and coming into the pre-election year of the 4-year presidential cycle. So what are our scenarios? Can't really go with the down one right now because we're not trending overall, and the technicals are trying to turn over more positive, especially in the short term and somewhat in the intermediate term. But we can't really go with that one either because, again, we're still not really trending, and we have this negative backdrop with the Fed going on that could be positive or negative. So we continue to go sideways because our ADX is below 20 and going down, so it's weakening, but it is positive overall. So we would default to the positive if anything. So our conclusion, the S&P is negative, but trying to turn positive. The same thing is happening in the short term as well as the intermediate term. Long term, we still remain positive as long as we're above the 200-day simple moving average, and we're also working off of a recent golden cross. Thank you. I hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.